Wednesday night, 6 to p.m. Eastern, the futures markets open in Asia and history begins. $688 billion gone. The liquidity that held up American markets for 20 years evaporated. Your retirement account sitting there right now, completely exposed. The algorithms are programmed and the sell orders are queued. And when you wake up Monday morning, your portfolio won't be there. This isn't speculation, this is mathematics. The generals of the bull market are about to be shot. The safety nets have holes, and the people who know aren't warning you. The countdown has already started, and most investors have no idea what's coming. Welcome to Boring Economy, the channel that treats you like the experienced professional you are. Listen, we know you've been around long enough to spot the difference between noise and signal, between hype and hard data. We don't waste your time here. If you value analysis that respects your intelligence, the kind of economic briefing you'd expect in a boardroom, not a circus, then do yourself a favor. Hit that subscribe button. Consider it securing your seat at the table where serious economic discussion happens. And tell us, where in the world are you watching this from? Are you monitoring this from New York, London, Singapore, Mumbai? Drop your location in the comments, because when Sunday night arrives, we want to know who was prepared and who was paying attention. Now, let's talk about what's really happening. The clock is ticking, and most investors have no idea that the financial world is about to change forever. Right now, as ordinary people enjoy their weekend, as families gather for Sunday dinner, as the world sleeps peacefully, the most dangerous financial event in modern history is preparing to unfold. Sunday night, 6 p.m. Eastern Standard Time, the Asian futures markets will open for trading. And when they do, the calm will shatter. This moment has been named Black Sunday, and the name fits perfectly because what happens in those first few minutes of trading will determine the fate of trillions of dollars in wealth. The trigger is simple. China has liquidated $688 billion worth of United States Treasury bonds. For those who don't follow markets closely, this number might seem abstract, but the reality is brutal. For 20 years, Chinese capital has been the invisible hand holding up American asset prices, the constant buyer, the reliable bid, the foundation beneath the entire system. That foundation is gone. And when a foundation disappears, buildings don't float, they collapse. Most retail investors believe the market is closed on weekends. They think their portfolios are safe, frozen in time, waiting for Monday's opening bell. This belief is dangerously wrong. The market never truly sleeps while Americans rest. The real money is moving in the dark pools of Tokyo, in the trading floors of London, in the algorithmic systems scattered across the globe. The market is alive, breathing, calculating, and preparing to strike. Sunday night carries a risk that few investors understand, the risk of a gap down. A gap down means the market opened significantly lower than where it closed on Friday. Not a gentle decline, not a gradual slide, but a violent drop, instant and irreversible. 10% gone in the blink of an eye, and here's the terrifying part. There's no time to react, no time to sell, no time to hedge, no time to protect what took years to build. An investor simply wakes up Monday morning, checks their account, and discovers their portfolio has been destroyed. The algorithms that control modern markets have been programmed with one simple instruction: sell first, ask questions later. When volatility spikes, when liquidity disappears, when panic begins, these machines don't hesitate, don't think, don't feel, they execute. And on Sunday night, when the Asian bell rings, the execution will be indiscriminate and brutal. China's withdrawal from the United States dollar system has created something financial experts call a liquidity vacuum. And liquidity is the oxygen that keeps markets alive. Without it, prices suffocate. Here's how crashes really happen. Most people think crashes occur because everyone sells at once. A stampede for the exits, a flood of panic. But that's not quite right. Crashes happen because nobody buys. The bids simply disappear. When the market searches for buyers on Sunday night, it will find an empty room. And when there are no buyers, prices fall and fall and fall until they find a level where someone, anyone, is willing to step in. That level could be 30% lower than Friday's close for those holding stocks or bonds in retirement accounts over this weekend. The risk is existential. 5 years of careful gains gone in 5 minutes. Pension funds across the country are already operating on thin ice, barely solvent, desperately dependent on market stability. A 20% drop would force them into immediate liquidation, selling assets at fire sale prices, which drives prices lower, which forces more selling, a death spiral with no bottom. Millions of retirees, depending on these pensions, are sitting on a fault line, and the earthquake is scheduled for tomorrow night. Usually, when markets face catastrophic drops, there's a safety net. The Plunge Protection Team, an unofficial group of government officials and financial institutions, steps in to buy stocks, to provide liquidity, to stop the bleeding. But this time, something is different. This time, they're out of ammunition. The government cannot print money fast enough to offset the selling pressure coming from China, from the BRICS nations, from sovereign wealth funds rotating out of dollar assets. The money printer, the magic solution that saved markets in 28 and 2020, in every crisis for the past 15 years, is broken. Not physically broken, but economically broken, with inflation still elevated, with the dollar's reserve status under threat. Printing more money would destroy the currency itself. So the plunge protection team will try. They'll throw everything they have at the market on Sunday night. But the wave coming from the east is too large, too powerful, too relentless. They will be overwhelmed. And when the safety net fails, the fall continues. But while stocks crash, while portfolios evaporate, while panic spreads, one asset is preparing to explode upward. Silver. The capital fleeing the dying stock market needs somewhere to go. And it's rushing toward the only safe haven left standing. The money isn't disappearing. It's moving from paper to metal. And those holding silver on Sunday night are holding the winning ticket. The stock market crash is just the beginning. And what most people don't understand is that modern finance is built like a house of cards. Touch one card and the entire structure trembles. Pull out one card and everything collapses. Sunday night's stock market destruction will trigger something far more dangerous, a crisis that moves from Wall Street to Main Street in a matter of hours. Because when people watch their retirement accounts vanish, when they see decades of savings erased in minutes, psychology takes over, and psychology is the most powerful force in finance. Monday morning before the sun rises, before coffee shops open, before the workday begins, Americans will rush to their banks not to deposit money, to withdraw it, every dollar they can get their hands on. This is how bank runs begin. Not with careful planning, not with rational calculation, but with raw, primal, I fear. Here's the problem. The banks don't have the money. They never did. The modern banking system operates on a concept called fractional reserve, which is a polite way of saying the bank only keeps a tiny fraction of deposits and actual cash. The rest is loaned out, invested, leveraged, transformed into assets that can't be liquidated overnight. So when thousands of people arrive at ATMs on Monday morning demanding their money, the machines will run dry, the withdrawal limits will appear, and the banking holidays will begin. The financial crisis and the banking crisis are not separate events. There are two sides of the same coin. When one falls, the other follows with mathematical precision. History has proven this pattern again and again and again. The crash of 1929 started on a Monday. The crash of 1987 started on a Monday. Why always Monday? Because bad news accumulates over the weekend, ferments, intensifies, multiplies in the dark. By Sunday night, fear has reached critical mass, and by Monday morning, panic is unstoppable. But there's one market that won't wait until Monday. One market that never sleeps, never closes, never takes a break. Cryptocurrency, Bitcoin, Ethereum, the entire digital asset ecosystem trades 24 hours a day, 7 days a week. And this means crypto will be the first domino to fall. Sunday afternoon, before the stock futures even open, crypto markets will experience what traders call a liquidity flush, a violent, sudden, terrifying collapse. Not because crypto is worthless, but because traders need cash immediately. Here's how it works. Big investors, hedge funds, institutions, they're holding positions across multiple markets, stocks, bonds, crypto, commodities, all interconnected, all leveraged, all dependent on borrowed money. When the stock market crashes Sunday night, brokers will issue margin calls demanding immediate payment to cover losses. And the only assets that can be sold instantly at any hour on any day are cryptocurrencies. So desperate traders will dump Bitcoin, dump altcoins, dump everything digital just to raise cash to meet their margin calls in the stock market. The selling will be savage, indiscriminate, panic-driven. Bitcoin could drop 30, 40, even 50% in a matter of hours. But here's the critical difference. Unlike stocks, crypto will likely recover, because unlike stocks, crypto is not tied to any government, any central bank, any failing system. It's sovereign, independent, free. Once the initial panic subsides, once the forced selling ends, people will realize that Bitcoin and digital assets represent an escape route, a way out of the collapsing dollar system. But that realization comes later. First comes the terror, and the terror will be spectacular. Now, let's talk about the bond market, because this is where the real destruction is happening. Most investors ignore bonds. They're boring. They're technical. They're not exciting like stocks or crypto, but bonds control everything. When China sells $688 billion in United States Treasury bonds, the supply of bonds increases dramatically. And when supply increases without matching demand, prices fall. And when bond prices fall, yields rise. This is not theory. This is mechanical, mathematical, unavoidable. Right now, the 10-year Treasury yield is approaching 5%, a level that hasn't been seen in over a decade. And here's why this matters. Stock prices are based on mathematical models that compare stock earnings to bond yields. When bond yields rise, the mathematical valuation of stocks falls. It's automatic, it's systematic, it's inescapable. If the 10-year yield breaks above 5%, the mathematical fair value of the S&P 500 drops by 30%. Not gradually, instantly. This is what's happening in real time. The bond market is destroying the stock market, and nobody on television, nobody in the mainstream financial media is warning the public. Why? Because they need retail investors to stay invested, to hold the bag, to be the final buyers, to absorb the losses. If the media told the truth, if they warned everyone about Sunday night, everyone would sell immediately, and the crash would happen right now on Friday afternoon. So instead, they stay silent. They keep the exits clear for the elites while trapping ordinary investors inside the burning building. The information asymmetry is deliberate, strategic, and devastating. The wealthy are already positioned. Short positions established, put options purchased, capital moved to safety. They're not just protecting themselves from the crash, they're betting on it, profiting from it. This is not conspiracy theory. This is how wealth transfers happen during every major financial crisis. The informed take from the uninformed, the prepared profit from the unprepared, and on Black Sunday, the largest wealth transfer in modern history will begin. The circuit breakers built into the stock exchange are supposed to provide safety. Automatic halts when the market drops 5%, 7%, 10%. But circuit breakers don't stop crashes. They only pause them. And sometimes the pause makes things worse. Because when trading halts, fear intensifies. Investors sit frozen, watching their screens, unable to act, knowing that when the market reopens, the selling will resume, often more violently than before. A trading halt on Sunday night won't be a sign of safety. It will be a sign that the system is broken. And when the system breaks, the rules change. Everything changes. There's a secret about the stock market that Wall Street doesn't want anyone to know. The entire system, the trillions of dollars in market capitalization, the appearance of strength and stability is built on a foundation of only 7 companies. 7, not 700, not 7,000. 7. NVIDIA, Apple, Microsoft, Amazon, Google, Meta, Tesla, the generals of the bull market. For years, these technology giants have carried the entire weight of American equities on their shoulders, propping up indexes, attracting capital, creating the illusion of economic invincibility. But on Black Sunday, the generals will be shot, and when the leaders fall, armies collapse. Here's the mathematics that nobody discusses. These 7 companies represent nearly 30% of the S&P 500's total value, 30% concentrated in just 7 names. So when liquidity disappears, when Chinese capital withdraws, when the selling begins, these overvalued technology stocks become the primary targets. Not because they're bad companies, but because they're the most expensive, the most bloated, the most vulnerable to repricing. A 20% drop in big tech overnight is not just possible, it's probable. And when Apple falls, when Microsoft stumbles, when NVIDIA crashes, the market has no leaders left, no generals to rally around, no safe havens within equities, no place to hide. The index itself becomes a trap. But the concentration problem is only the beginning. There's something far more dangerous lurking beneath the surface. Leverage, hidden, pervasive, explosive leverage. Record amounts of stock have been purchased with borrowed money. Margin debt at levels not seen since the dot-com bubble. Investors borrowing to buy more shares, convinced that stocks only go up, convinced that leverage amplifies gains without risk. This belief is about to be shattered. When stock prices drop, even by a small amount, brokers immediately issue margin calls. A margin call is simple but brutal. The broker demands immediate cash to cover the losses on borrowed money. And if the investor can't produce that cash within hours, the broker sells their stocks automatically at whatever price the market offers. This is forced selling. Selling driven not by choice, not by strategy, not by analysis, but by mechanical necessity. And forced selling drives prices lower, which triggers more margin calls, which creates more forced selling, which drives prices even lower, a death spiral. On Sunday night, millions of leveraged traders will receive the call that destroys them, the call they never imagined would come, the call that liquidates their entire portfolio in minutes. The leverage that built the bubble will become the force that obliterates it, and there's no stopping it once it begins. But the contagion doesn't end with stocks. It spreads like a virus into every corner of the economy. Real estate. When people watch their portfolios collapse, when they see their net worth evaporate, they don't feel wealthy anymore. And people who don't feel wealthy don't buy houses. This is called the wealth effect, and it works in both directions. Rising portfolios make people spend more, invest more, buy bigger homes. Falling portfolios make people freeze, panic, cancel plans. Pending home sales will be canceled on Monday morning. Luxury real estate will stop moving entirely. Open houses will sit empty. The housing market, already fragile, already overpriced, already teetering, will receive the final push over the edge. Black Sunday triggers the housing crash that analysts have been warning about for months. The stock crash and the real estate crash become one synchronized disaster. Now let's talk about something most investors have never heard of: corporate buybacks. For the past decade, corporations have been the biggest buyers of their own stock. Not individual investors, not pension funds, not foreign capital, corporations themselves. They borrowed money at historically low interest rates and used that cheap money to repurchase their own shares, artificially inflating stock prices, boosting executive compensation, pleasing shareholders. It worked on for a while, but interest rates aren't low anymore, and the economy isn't growing anymore, and the cheap money is gone. Without corporate buyback support, the stock market loses its artificial floor. The prop has been removed, and now the market will discover the true value of these companies, the real price without manipulation, without buybacks, without financial engineering. That price is much, much lower than where stocks trade today. The discovery process will be painful. But wait, there's another mechanism most people don't understand. The VIX, the volatility index, the fear gauge, the measurement of market panic. For years, the VIX has been artificially suppressed, kept low through derivatives, through options trading, through institutional manipulation. A low VIX signals calm, stability, confidence. But on Sunday night, the VIX will explode. 50, 60, possibly 70 levels that indicate absolute terror in the markets. And when the VIX spikes, something catastrophic happens automatically. Risk parity funds, massive algorithmic trading systems managing hundreds of billions of dollars, are programmed to respond mechanically to volatility. When volatility rises, they must sell stocks. Not because they want to, not because they think stocks are overvalued, but because their algorithms demand it. This mechanical selling adds billions of dollars of additional sell pressure. To a market already drowning in panic, the machines will crash the market faster than any human ever could. There's no emotion, no hesitation, no mercy, just code executing relentlessly. An algorithm doesn't negotiate, doesn't reconsider, doesn't stop. It sells until the parameters reset or until the account reaches zero. And there's one more wild card lurking in the shadows: geopolitics. The Middle East is a powder keg. Iran threatening the Strait of Hormuz, oil shipping lanes under constant threat. One wrong move, one missile, one miscalculation, and energy prices explode. China is circling Taiwan. Military exercises intensifying, rhetoric escalating, tensions rising, a blockade, an invasion, even the threat of conflict sends risk assets into freefall. Any major geopolitical event over the weekend amplifies the crash exponentially. The markets are already fragile, already breaking, already on the edge. Bad news from the war zones becomes the accelerant on an existing fire, and the timing couldn't be worse. For an entire generation of investors, this will be their first real crash. Everyone who started investing after 2008 has only known one thing: number go up, buy the dip, hold forever. Stocks only rise. Trust the system. This crash will destroy that faith permanently. These investors will realize for the first time that the stock market isn't a wealth generator. It's a wealth extraction mechanism, a system designed to transfer money from the uninformed to the informed, from the unprepared to the prepared, from the emotional to the calculated. This loss of faith will create a generational trauma, and traumatized investors don't come back. They withdraw their money, move to cash, never return to equities. The result is a long-term bear market that could last years, maybe decades, because once trust is broken, it doesn't rebuild quickly. The amplification mechanisms are all aligned: concentration, leverage, forced selling, buyback cessation, algorithmic triggers, geopolitical risk, psychological trauma, each one feeding the next, each one making the crash worse. This isn't just a market correction. It's a systematic dismantling of everything built over the past 15 years. And it begins Sunday night, 6 p.m. Eastern, when the futures open in Asia. The amplification begins. Black Sunday isn't just about one night of chaos, it's about what comes after. The world that exists on Monday morning will be fundamentally different from the world that existed on Friday afternoon. Markets will be shattered, confidence destroyed, illusions evaporated. But the real damage isn't measured in percentages or dollars. It's measured in decades, because what happens on Sunday night will echo through the financial system for a generation. Consider the young investor, 25 years old, fresh out of college, just started contributing to a 401k. This person has never experienced a real crash, never felt the sickening drop of watching years of savings disappear overnight, never understood that markets can go down and stay down for years. Sunday night will be their education. Brutal, immediate, unforgettable, and the lesson they learn will shape their investment behavior for the rest of their lives. They'll remember the terror, the helplessness, the betrayal, and they'll never fully trust the stock market again. This psychological scarring creates what economists call a generational bear market. Not just a temporary downturn, but a fundamental shift in how an entire generation views wealth, risk, and investing. These traumatized investors will pull their money out, move to cash, to bonds, to anything that feels safe, and they won't come back. Not in 6 months, not in 2 years, maybe not ever. The stock market depends on constant inflows of new capital, new believers, new participants, new money. When an entire generation stops participating, the market starves, prices stagnate, growth stops, the bull market mythology dies. This is the long-term consequence that nobody's calculating. Now let's talk about pensions, because this is where the mathematics become truly devastating. Pension funds across America are already operating on razor-thin margins, desperately needing 7% annual returns just to meet their obligations to retirees. 7% every year without fail. A 20% crash on Sunday night puts these funds years behind schedule. Years. And here's the cruel reality. They'll never catch up. The math doesn't work. When a portfolio drops 20%, it needs to gain 25% just to break even. And gaining 25% when the market is broken, when capital's fleeing, when growth is dead, is virtually impossible. So what happens? Pension benefits get cut. The promises made to teachers, to firefighters, to police officers, to municipal workers, those promises get broken. Retirement ages get pushed back, monthly payments get reduced, cost of living adjustments disappear. Black Sunday doesn't just destroy wealth today, it steals food from the mouths of future retirees. People who worked 30 years, who contributed faithfully, who trusted the system, will discover in their 70s that the money isn't there. The social consequences are unthinkable. But while institutions crumble, while pensions fail, while retail investors panic, something extraordinary happens in the precious metals market. Throughout history, every major financial crisis has a winner. One asset class that not only survives, but thrives. In 1970, when inflation raged and stocks collapsed, it was gold. In 2008, when the banking system nearly died, eventually it was gold again. In 2026, it will be silver. Silver is the most undervalued asset on the planet right now, trading at a fraction of its historical ratio to gold, ignored by institutional investors, overlooked by the mainstream, sitting quietly, waiting for its moment. And Black Sunday is that moment when trillions of dollars flee the stock market in panic, when investors desperately search for safety, when the dollar itself comes under question. Even a tiny fraction of that capital moving into silver will send prices vertical. The silver market is small, incredibly small compared to stocks or bonds. It doesn't take much buying pressure to move the price dramatically. A God candle on the silver chart, a massive vertical green spike pushing prices past $100 per ounce in minutes, is not just possible, it's probable. This is the safe haven rotation, the moment when terrified capital abandons paper assets and rushes toward hard assets. Gold will rise, certainly, but silver will explode because silver carries something gold doesn't. Industrial demand. Silver is used in electronics, solar panels, electric vehicles, medical equipment. It's both a monetary metal and an industrial commodity. This dual nature gives it leverage that gold lacks. When the world rebuilds after the crash, when infrastructure projects accelerate, when green energy expands, silver demand increases, while supply remains constrained, the price trajectory becomes astronomical. But there's something else happening, something unprecedented in modern financial history. The dollar itself is under attack. Normally, during a stock market crash, investors rush to the dollar, the safe haven, the reserve currency, the global standard. But this time, the crash is being caused by the dollar losing its reserve status, China dumping treasuries, BRICS nations moving away from dollar trade, central banks diversifying reserves. The dollar is the problem, not the solution. So capital will flee, not just from stocks, but from dollars. Where does it go? Gold, Swiss francs, Bitcoin, and silver. This creates a nightmare scenario that most economists thought impossible. The stock market crashes and the dollar crashes simultaneously. Stagflationary collapse, prices rising while asset values fall, the worst of both worlds happening at once. For those positioned in precious metals, this environment is transformational. While others panic and while others lose everything, silver holders watch their wealth multiply. Not because they got lucky, but because they understood the mathematics. They recognize that liquidity is the foundation of all asset prices. And when liquidity disappears, only tangible assets survive. The time to position is now, not Monday, not next week, not after the crash begins. Now the preparation window is measured in hours. Those holding stocks should consider hedging immediately. Put options, inverse ETFs, moving to cash, anything to reduce